Hey everybody, the S&P 500 had a great year in 2023. It was up by about 26% when you include dividends. That's one of its best years in a while. So, not all stocks are doing quite as well, and we're going to talk about some of those. Before we dive in, take a minute, click subscribe to my channel, and check out the link you see on your screen for a message from our sponsor, The Motley Fool. It's the best way to support this work we're doing on YouTube, and you can get the top 10 stocks to buy right now. So, we're going to talk about some stocks that are down by 50% or more. And I know Tyler has a really interesting one. I think his is down by a significant amount more than that. Tyler, what are you looking at?
Yeah, so the company I've been following, one that I own, and I can't say that 2023 was a resounding year for it, is SolarEdge Technologies. The the primary product that it sells is called an inverter. It's the device that connects a solar panel to your home for residential solar installations. Kind of converts the direct current electricity that a solar panel produces, converts it into alternating current that is used in the plugs in your home. It sounds very basic. There's a little bit more going into that than just, an inverter. That's like a thing you make in physics class in your senior year of high school. So not the most technologically advanced thing, but I can assure you what they're making is a little bit better than that. In the past year, and we're recording on the 12th, but it's pretty close to 2023's performance. The stock is down about 75%. And the biggest reason that we've seen this is because with rising interest rates, it has drastically slowed down the rate of residential solar growth. Residential solar is a large investment for a lot of people on their homes, and as a result, when financing costs go up, it's just a less lucrative thing to do, as if you could get a home equity loan for 3-4% versus today where they're over 8%. There was also a drastic change in the largest market, which is California. There's no getting around that. What California rules say goes. What happened in 2023 was there was a change in what are called net metering rates for residential solar, which basically means like net metering is if you pay X cents per kilowatt hour for the power coming into your house, net metering allows you to sell back that electricity back into the grid for X kilowatt hours as well. However, because of so much residential solar had been installed, and things like transmission costs and all of the other like non-producing the energy costs related with electric providers or in utilities, they changed the rules a little bit so that you couldn't just sell electricity at any time and get market rate. They were looking to kind of discourage times when like the most power is produced, which is the middle of the day, and energy was really cheap, and trying to encourage people to do things like install batteries with them, install batteries with them, such that they could release energy at times when it's actually needed more. And so if you didn't have one of those storage systems, the rate that you could sell back into the grid was demonstrably less than what it was, prior to this net metering change. And so again, changed the economics for a lot of people and made it a little bit less attractive. And as a result, we saw slower results for SolarEdge as well. It's kind of, we'll call it not necessarily duopoly, but its largest competitor, Enphase Energy as well. So there was declines there. The Europe market has also been quite slow. The economic growth there has been much slower, and a lot of malaise from conflicts going on in Ukraine there as well. So all in all, it's just been a really tough business, and I've been watching it a lot because despite all of these challenges, it still has been a good business. This has been a fast growing business that still was generating 40% gross margins, was cash flow positive, was working on some ancillary stuff that, I don't know if it had worked out yet, but its core business looks strong enough. It could go for quite some time, but after seeing this really precipitous decline in the stock and kind of thinking about interest rates, it does have me wondering, can this business sustain itself in a higher interest rate environment? And that's going to be one of the questions that I'm really going to be looking to answer in 2024 as it tries to figure out, what kind of business this looks like in a time when financing costs for residential solar are just that much higher.
Nice. I like SolarEdge. I've been following them quite a bit, and that's really, I didn't realize they were down that much. Um, but I'm going to talk about a stock that people have probably heard me talk about a million times, Boston Omaha Corporation. Ticker symbol is BOC. And regardless of whether you like their business or not, there's a lot to like about the stock as we go into 2024. And to be fair, they're not down quite by 50% over the past year. They're definitely down more than 50% from the high. They're down about 40% over the past year. There's a few things that I think need to it could happen with lower interest rates, especially with this stock. For one thing, the Boston Omaha asset management business that they're really starting to build out, or they started to build out at the worst possible time, right before interest rates rose. The fundraising environment is kind of terrible right now. Um, Investors who have millions of dollars sitting on the sideline are more than happy to put it in, and CD is earning 5% at the moment, as opposed to giving it into somewhat risky investments. So the cost of capital, the fundraising environment for Boston Omaha Asset Management could definitely improve as we head into 2024. I wish management would talk about it a little more. Hopefully, when we get their annual letter, we'll hear a little bit more about how the progress is going. There's also a lot of real estate exposure in Boston Omaha Asset Management. They recently acquired an asset manager, 24th Street Asset Manager, that they used to have a minority stake in, and they have a couple of commercial real estate investment funds. And because it's been a privately traded or a private business, we don't know a lot about what's in there. There could be a lot of office real estate. We don't really know. So I'd love to hear a little bit more details from management on that. I think that's holding the stock price down, just the uncertainty of what they own. But there's also just kind of the general cost of capital of the business. They're a growth business. They like raising capital to grow on occasion. The billboard business, the insurance business, the fiber broadband business are all doing pretty well. In the most recent quarter, all of them grew year over year pretty nicely. So those results are looking fine. One big head scratcher for me is the company's roughly 20% stake in Sky Harbor, ticker symbol SKYH. That stock has more than tripled over the past year. Boston Omaha is one of the largest shareholders. Like I said, they have a 20% stake and warrants to buy even more if the price goes up. And the growth in Sky Harbor has not been reflected in their stock price at all. In fact, their stock has headed down while Sky Harbor's been going up. The Sky Harbor investment alone should have added about $100 million in intrinsic value to Boston Omaha over the past year. And that's just not reflected at all in what we're seeing with the stock price. So I think as 2024 goes on, especially if Sky Harbor continues to do well, um, it could be a really good year for this stock. It'll be a nice rebound. It's got a long way to go before it takes out the all-time highs. But I think as interest rates fall, this could be one of the bigger beneficiaries. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.